Recording in progress.
Okay. Well, good morning, everyone. Today's session is going to be on developing your budget and pro forma. One thing I make that distinction is that the budget. Good morning, everyone. Today's session is going to be on developing your budget and pro forma. One thing I make that distinction is that the budget. Good morning, everyone. Oh, let's see here. Let me get this line recording. I gotta stop. One thing I make that distinction is that the budget. Good morning, everyone. Oh, let's see here. Okay. This session is line recording about your budget and reform. I gotta stop. There we go. One thing I make that distinction is that. Okay, let me cut that out. There we go. Oh, no. All right. Now that's. Okay. So get back to share screen again. There we go. So when we look at talking about budget and pro forma, a budget is basically something that you have as an idea as far as you're looking at your company, what you think is going to happen. So it's just a best guess based off the best information you have. And what a pro forma is it takes it to another level where you're looking at assumptions going into the future. So you have a budget typically for a year or so, but then pro formas get a little bit more detail and more analysis so that you can determine maybe 2 years down the road if you're trying to go after a particular thing as far as expanding on a certain line or product, you want to go and get more detail to it. So they're almost as similar, but pro forma is much more detail and has more and more analysis. Just a reminder, if you're part of the Loving Myself development group, Kingdom Economics book is out there. It's part of the material. That's a book I wrote several years ago, but it gives basically my philosophy of, as a business, as a person that you're growing with your business, you are the same as your business. You are one and the same. I had grown up and was taught for years that a business is separate than you as an individual. But the reality is that when you look at doing things in purpose of who you are one and the same. So the better you are as a person, the better your business will be. We also talk about different business entities. In the first 2 sessions, if you want to go back to looking on Facebook, or also I load them up on YouTube, there's business entities and developing your business. And I talk about all the different business entities that I usually get questions on. So I made sure that I did a session on that to talk about the difference between a sole proprietor, LLC, partnership, corporation, nonprofit. So you can refer back to that. Now, the essence of all these sessions, and we'll have 2 more sessions, one more in November and one more in December. In November, our session is going to be on understanding financial statements, because as business owners, sometimes, when you're trying to make money, because that's ultimately what you want to do as a business owner, or if you're a nonprofit, you want to provide services, but you can't have no margin, no mission. Meaning, if you don't have an operating margin to be able to reinvest into people or to the organization, you're not going to be able to continue to serve people. So, so that's going to be the next session in November. Then in December, we're going to have it kind of a little bit open. We're going to talk about what's some of the best ways and tips on hiring the best people. If you're looking at expanding your business, you need more support, resources, employees. So we'll talk about some different opportunities to be able to do that. In addition, I'm also going to have it open because December is an open topic, so that I'm going to, ask over the next 2 months if you are that you can either send me through Instagram, Facebook, or through the group, Loving Myself Business Network group. Send me any topics that you want to go over. I'm going to start compiling those so that I can start setting for next year the topics each month that we can go and cover. So that's going to be an opportunity, as over these next couple months, share with me some of the things you're interested in, and then I'll look at developing and providing sessions on them for next year. But this year, we're working through elements of a business plan. So we started several months ago, talking about business entities, all the different aspects of what a business plan is. And if you would follow that through and apply that to your business, you could be developing your business plan for each of these sessions. So here's the elements of the business plan, executive summary, company services, your particular services that you have as far as products or services, market analysis summary. We did that last month, strategy and implementation, and then management summary and financial plan. So today we're going to be going over the financial plan, which is part of the business plan, which is the budget and performance. So let's get into about budgeting. Now, we all should be looking at having to develop our personal budget. And then when you do your personal budget, you take all your sources of income and then you look at your expenses to see how much you have, hopefully each month, that you can be able to either put into savings or look at other things you want to go and use it for in the future, whether it be retirement, school, if you have kids, things like that. Well, the same elements is used in doing your business budgeting. Um, okay, so let's look at some of the factors that are involved in dealing with a financial plan. We're not going to get into all of these, but I'm just going to touch on them. If you have some specific questions, we can follow up on that. But in a financial plan, you have to have assumptions. And what I mean by assumptions is, keep in mind, a budget, financial plan, pro forma, it's your best guess based off the information you have. So there's certain things that you have to apply assumptions in as you're looking at projecting numbers out. Like, for instance, if you go from year to year, there's such a thing called inflation. Prices of what we purchase tend to go up over time. And so an assumption that you would want to have is saying that if there's something like, if I purchased office paper for my business today, in a year's time, I should expect it to go up by inflation. So an assumption I would say is, and you can go in, and Google, what is the CPI, the Consumer Price Index? That's typically the economic version of what is inflation. So what's the price increase from year to year? And typically right now, if you look at that, it's around 2.5% that you can expect prices going up. And the reason why that's important to know about those things is because if you price your products, you have to price your products too accordingly so that they can also cover inflation. So if you just keep your product the same, and you have a good profit margin, and if you don't change that pricing or you don't sit there or lower your costs, then your profit margin will start decreasing over time, just because the cost of what you purchase from your materials and supplies will go up. And so that's something you have to look at as part of an assumption. You got to look at how much do you want to do as far as salary increases for yourself or for your employees. What's going to be the cost of healthcare? If you have, healthcare typically is going up but double digits, 10 to 15%, depending upon. So you have to factor that in. So when budget for next year, you can't just say, okay, health insurance is going to be the same. You have to put an inflation factor into that. So these all things are a part of when you're looking at developing a financial plan. You want to project your profits or loss. You want to know there are times where there might be, depending upon what type of product or service you're offering, there are some services that you offer that might be break even, might be at a loss, or might be at a profit because it might be a feeder for other type of services. So you need to be able to understand that, especially if you have multiple lines of business. Projected cash flow, that's important because cash flow, there's a saying out there in the financial circles, cash flow is everything. If you could be running a great business, but if you're not having positive cash flow, then it's going to die. Eventually going to go into bankruptcy because you're not being able to cover the cost of supplies, paying people if you're not bringing enough cash to actually pay people. So one of the things that, when you do a budget, typically you do it on what you anticipate with revenue and expenses, but that revenue expense might not be coming in at the same time. So even though you have a budget, there's a separate form that we call as a cash flow that you take your budget and you kind of convert that into cash flow, into a cash flow statement so that you can say, this is what I anticipate my revenues are, this is my expenses, but then I'm going to time them out of actually how I expect them to come in and do it on a cash basis. So when you get into it, it's not just having a budget, but if you're really operating your business, you also want to have a cash flow statement also. So you know how the cash is coming in. So you know whether or not you need a line of credit or a business loan to operate for a certain period of time. Then we also have, a balance sheet. And we'll talk about a lot of these things next month when we talk about understanding financial statements. So we'll go over the income statement, the cash flow statement, the balance sheet. But the balance sheet is basically what you possess as far as assets, cash, accounts receivables, inventory, equipment versus what you owe, your liabilities, your vendors, what you have to pay on. And then whatever's left is your net worth, how much you're worth. So when you always hear about people saying, what is their net worth? What they're really saying is, how much are they really left over if they had their assets and then they paid off all their liabilities? What would they possess? And that's your net worth. And your goal is to be able to grow your net worth each year. If not, you're eroding into what you own. And eventually, if you erode into much of what you own versus what you owe, then that's when you go into what you call debt. And that's when you're really behind on debt and different things. So that's why it's important. It's going to be for next month to understand these financial statements and what all that's involved in. And then there's business ratios. These are basically key indicators for financial folks that will look at your business so you can see if it's a favorable trend. For instance, there's a such thing called a quick ratio. Basically how much of your your cash over your liabilities, is it positive? And certain ratios will indicate whether or not things are favorable or unfavorable. There's ratios on how much cash, how much your receivables are out there before you collect it and convert it into cash. So if you have a receivable ratio that's converting cash in at 45 days, then what that tells you is that you have to have enough cash on hand for your bills for 45 days to cover that, because you're not, for when you invoice out, it might take 45 days for you to bring in that cash. And if you don't have enough interim financing or cash reserves, then you're going to be in trouble on a cash basis. So there's a lot of different ratios are out there that will determine if you're too debt heavy, if you have adequate current assets versus current liabilities, and all those different things. So we'll kind of take a little bit look at that next month, but those are all things that are part of a true financial plan that you have as part of your business plan. So some of the requirements that you're going to need in order to be able to generate some of your financial plan is a 3 to 5 year budget or projections. That's typically what's expected in a business plan. You're going to also want to have, if you're operating your business already, you really want to have financial statements. So that because a lot of these projections are based off of existing financial statements. You want to have your tax returns, because tax basis is, it might be a little bit different than your financial basis. For example, depreciation. Depreciation is something that, like, for instance, if you buy a car, and many of you probably heard that it's not good to look at a car as an investment, because when you drive it off the lot, it depreciates. What is it? So that means the value of what you pay for automatically reduces. Well, what depreciation is, when you look at it from a financial statement, is you take an asset like a house, equipment, vehicles, and you might, for instance, if you have a vehicle that you have that's in your business that you might be picking up people, or a delivery vehicle, it might cost you $30,000. And so you can finance that, or you pay for it at one time. But the way that you have to record that in financial statements and also tax basis is you have to spread it over the useful life. So you might be thinking, I'm going to take this 30,000 and write it off as a deductible expense. But that's not necessarily the case with depreciation of capital assets, because you have to spread that cost over the life of that asset. So that's $30,000 vehicle that you pay out front. You can only take it as a business deduction maybe over 5 years. And you might have to take $6,000 a month. I mean, $6,000 a year of that as a deductible business expense. So that's why you need capital financing, understand cash flow, because there's certain things that you have to put out cash with that you're, for a tax wise or business deduction, you're not going to be able to take that fully at the time. There's some things that you can look at it. It's called a 179 capital, where you can take it once, but then you have to keep that asset for 5 years. If you take it all at once, if you get rid of it, then you have to recapture that. That's a lot of tax stuff, but that's why when you really get into it, when you're planning for your business, that's why I always recommend make sure you have a lawyer in there, and also an accountant in there too, because when you need to get to some of these high level activities, you're going to need that expertise. And then audits, if you have to do, if you're required to do audits, you need to make sure you have those as part of your record too, because if you have debt with a bank or any other type, then they're typically going to want to see an audit, because they invested money into your business. So they're going to want to see an audit. If you are a nonprofit and you want to get grant funding, or you want to get it from a government contracts, they're going to want to see an audit. So those things, you need to make sure you keep those records, and those are good because they substantiate your financial statement from an independent firm. And then you can rely on those numbers for projections and trends and things like that also. Of course, if you guys have any questions, you can just let me know. You can put the hand up thing. Now, going back just to budgeting overview, for those who attended the Loving Myself Personal Development series that I did last year, that I also, if you are on Facebook, you can request to get into that group also. And that group has about different things as far as personality profiles, different testing, understanding yourself, emotional intelligence, but we also talk about personal budgeting and finance. So I pulled this slide from there because it just shows you understanding that whether it's personal budgeting or business budgeting, the elements are still the same. When you look at basically understanding money basics, the principles of economics, this is why you have to learn budgeting. Economics is the allocation of limited resources and unlimited wants. So what that basically is, and for those that might have children, you understand this. Children want everything they can see. If they're going into the stores trying to pull on different things, that's the wants. But the limited resources is the money that you can pay for certain things to go and take out of that store. So what economics does is helps you bridge that gap so that you can be able to have a plan to maximize your limited resources, but with your unlimited wants. So the tools that you use to be able to do that is a budget, a business plan, strategic plans. Those help you get that discipline. And if you don't have a budget, then that's when you get yourself into overspending, paying more for than what you can afford, all those different things and disciplines. So a budget helps provide that discipline from an economic and financial perspective. And then there's two other factors when you're looking at money basics, and that's why we're into, as entrepreneurs, developing and building, is income. Income is earnings generated from direct personal activity coming in. It could be basically a job, whether or not you work a job and then you're using that money to help fund your own business, or you're employee of your own business. That's still a job. That's a position. So that's earnings generated from your own personal activity. And then you get into wealth. And this is a philosophy that people have to understand. Wealth is different than income, because wealth, you have perpetual earnings that are generated from the activities of others. That's the distinction between income. With income, you got to work it yourself. If you don't work it, it doesn't come in. But with wealth, it's coming in, even though you're not working it directly. And that's where businesses, investments, and branding are examples of wealth. The one that I use as example, since it's football season, even though we're in the poor Steelers, we'll see what they do tomorrow. but players that are making $20 million a year are under an income philosophy. Why? Because they have to get out there on the field and get smacked around in order to get that paycheck. The owners of the teams are under wealth. So you could be a millionaire and still be under an income mentality. It's about the fact that, do you have things working for you? So as entrepreneurs, as we build our business, can you leave that and still have it running? And so that's why we all on different stages. There's times where, right now in my stage in my life, I'm still kind of under an income, and because I'm working at building it, I'm trying to add another consultant so I can build that up. So to grow that, so I can get to a wealth stage, so I can be able to start, because my goal in my business is setting up my business in multiple cities, because the way that my structure is set up in consulting, I can do that. It's about connecting, dealing with businesses and understanding that. So I'm concentrating now, but I'm developing a platform that I can do it in multiple cities and have satellite offices. And then when I have satellite offices, I can put people over that to run that, to really move into a wealth type business. So we all in those different stages as we go through. So that's why you have to keep looking. It can't just be tied to you. If it's tied to you just directly, it's income. But ultimately with business, or when we want to go into entrepreneurs, is that we can get these businesses operating for us. So. Here's an example now of a budget. So, and this is just an example, but it just gives you an idea of what are some of the elements that are tied into a budget. Now, this is it's a little bit complex, but it gives you an idea of some of the things you have to know. Here you have revenue. So the revenues are kind of summarized, but you can have detailed revenues of all your products and services. The more that you get into, the better it is. So when you're doing your own budget, it's going to be very detailed, but when you need to produce it for others, you can summarize it down. So basically, when you're looking at your revenues, you're looking at your typical things of products and services. In a nonprofit environment, it still can be program income. It can be contributions, foundation grants. Those things are what are the sources of inflows coming into your particular business. That's your revenues. And those are based upon what you generate through your activities. Then you get into some of the other things of your costs. Those are your expenses. What are your expenses? And typically, and we'll go over it when you look at break-even analysis and things like that. I'm trying to keep it general because I don't want to get people too caught up in it, but that's why I would always say you're going to need an accountant to really get into this also. But when you break down your expenses, there's two different categories. There's called fixed costs, fixed expenses, and then there's variable. And the reason why that's important is when you do proformas and budget and things like that, it's important because to project things out, you need to know what things are actually fixed and what are variable, because what a variable cost is based upon a direct relationship to you producing revenue. For instance, suppose that you are running a restaurant. Well, a variable cost to you running a restaurant is the supplies needed to make the food. So the more food you need to make, the more of that of food materials you have to purchase. So that's a variable type cost. So that has a relationship tied to the product that you're producing. So it can go up and down based upon whatever that need is. That's why you need to make that distinction. And then you need to get into even more detail of breaking down, because there's certain things you might need to break it down between breakfast, lunch, or dinner, and all those different costs and things like that. So variable costs flex up based upon your particular product or service. Fixed costs are going to be that you have to pay out regardless, like light bill, rent. Those are fixed costs. And the reason why is you need to know those things. Distinction between variable and fixed costs is that when you do analysis to be able to get to what is your break-even point. See, and we'll talk about some of these things next month. That's why I just want to introduce them now, and then we'll spend a little bit more time giving you an example and showing you. But these are the things that are part of your financial plan that a potential investor or banker is going to be looking at. Because if you start a business, and this is why you need to have an understanding, if it's going to take 3 to 5 years, how long is it going to take for you to break even and make money? And the only way you can do that is through this cash flow variable fixed income analysis part, because what it will do and project out to you is, if you do this a particular product or service, and it's going to cost you this much plus your fixed costs and things, it might take you a year and a half to come to a break even, or to make money, or it might take you 3 years. And you need to know that, so that you know what are you going to do to be able to finance yourself over that particular time. So when you're looking at your budget and your financial plan, you need to have the information there, so that individuals can be able to see what is your break-even analysis. Now, when you actually do the financial plan, you lay it out there, and that's into the detail part, but you're going to have to also kind of include that in the summary, in your executive summary, so people know that you are aware of how long it's going to take for you to start making money. And when you're requesting money or people to invest into your business, you can let them know, if you invested in my business and this is my plan, by 15 months, you'll be able to see this coming back to you, or 2 years or 3 years. And so it gives you a better insight. If you can tell me that, then I have a better comfort level of you as a business person, knowing that if I give it to you, you have an idea of what's happening, and you can plan and watch for that. Yes, Roberta.
So one of the questions that I have is that, being that I have been my primary investor in my own business, so I'm saving all my receipts, because I'm gonna use that at tax time.
Right.
But being that I am my primary investor, and I'm looking to, number one, build traction on websites, build traction on Facebook, build traction on all these things by doing all these creative things, and I receive donations per se. That I'm just like, I'm real confused and concerned at the same time in regards to the financial piece. I mean, I'm going to set up a bank account for the business, but then if I don't spend any of that money on anything, it's just sitting there.
Right.
Or let's say that, someone just says, oh, this sister seems like she's doing a great thing. We want to invest and give her, let's say, an office space for maybe 6 months. I'm just throwing out things. I'm like so befuddled as to how that works into a budget plan. Like, I guess I'm just lost, because I'm starting from ground zero, and most of it is coming from me but I'm being creative in how I'm trying to get attraction and interest in, you know, get people to talk about my business. So they may be like, well, we need to talk to her a little bit more. I'm not
Okay.
even sure how I would put a budget in a business plan at this point.
Well, what you're talking about, and this, what I'm going over is for more established businesses and all
Okay.
that. But what you're really talking about is a startup business plan. So
Okay.
that's a different, unique thing, which is similar because even when you go into your business plan, there's typically a separate startup budget that you have if you're starting up versus the one that plans out for the next 3 to 5 years. So in the startup budget, those are the things that you talk about is you lay out over the 6-month period of time or year that you're in startup phase. These are, you know, you still got to know what are my particular expenses, what are the things I'm going to be doing. So you still plan those out. Then the sources of revenue are going to be told, and it could be, like you said, it could be a foundation grant. It could also be your own personal money. So you need to be able to know and budget that out too. So you have an idea of that too. Because that doesn't even stop, because even if you're into your business and operating, and there'd be a time where I might be doing some services and I'm waiting for some of my invoices to be paid. Well, I still pulled out a paycheck from my business, right. But then there are times where I have to put back in. So that's an owner capital investment. So you, based on your setup, you're still contributing as an owner capital investment into your business. And so that still happens. So that would be a capital investment line as far as source of income, you know, that you would have as a budgeting to it.
So if I am reinvesting into my business, and this is a tax question that I have not sat down and talked to my tax person about, if I'm reinvesting into my business, that goes on my personal income tax, not the business income tax, correct?
Well, here's the bit. What's your business entity? Is it set up as an LLC or sole proprietor?
Sole proprietor at this. Well, okay. So here's the thing about North Carolina. When you file for a 501c3 in the state of North Carolina, you have to have 3 executive board members. You don't have to have any more, but you have to have a minimum of 3 to set up your whole board. And then here's where it gets interesting too. They also make you determine if your nonprofit fails and you have money, who you would like those funds to go to, another nonprofit.
Yeah, that's typically of any nonprofit structure because it's public owned. That's what makes it a nonprofit. Yeah.
But we ain't got no money, so.
So basically you're setting up as a nonprofit. Okay. So you're talking about a nonprofit. So this is why it's different, you know, an LLC sole proprietor answer is going to be different than a nonprofit because technically you can't invest into a nonprofit because it's publicly owned. Now you can make a donation or contribution to your nonprofit, but you can't just pull that out of a nonprofit.
Right.
Okay. So that's one thing that's different. So if it's a nonprofit setup, you can make a donation or contribution to your nonprofit, but it's not equity for you to pull out. Okay. Now, if it's a for-profit, like an LLC or sole proprietorship, then the way that you have to work that is any capital investment you put that in, okay, and it goes in on your books in the equity section as a capital investment as part of ownership, your increase of your ownership. Now, you can pull out money that you put in your business as a for-profit or LLC, and it's viewed as a draw. So you can make a draw up to the value of what you have put into it. And the way that you put into your business is through your own capital investment. So if you put money into your own business, that's a capital investment. And then the other way that you put money into your business is by running a profit, and that money goes into reserves. And then when you pull that money out as a draw, but you're going to be paying dividends on that because it's viewed as if it's coming out of your LLC, it's viewed as a K1 dividend reinvestment coming back out. So then you pay dividend tax on that on your level, on your individual level.
Because right now I just, of course, I'm like everybody else in America, I'm looking for free money. so I've entered all these grant competitions or whatever. I just needed to make sure that I was covering me, because I put a good amount of money. I mean, for someone who doesn't have a job, I put a good
Right.
amount of money into this.
But see,
And
but that goes back to, that's why I said business entity and the structure you're set up. If you're set up as a LLC partnership and all those sole proprietor, then that's capital investment. But if you're a nonprofit, there is no such thing as capital investment. It's because
that's okay. I'll take it as a donation, because I'm gonna take all my receipts and say these are donations.
Yeah, you put it as as a donation into the organization.
Right.
Yeah.
Right. Okay. Thank you.
So as we, so if you look at your revenues and then you have your expenses, then remember I talked about depreciation. That's a part of an expense. That's for your capital purchases for equipment, buildings, vehicles, those things. Even though you're up front on the money, you have to allocate that expense over the useful life of that particular asset. Then you also got to look at interest on loans and things like that. So you factor those out and to come down, and then you get into this EBITDA. We call this EBITDA. That's earnings before interest, taxes, depreciation, amortization. And so what's important, reason why that's important in it, and we won't go over too much now, but if you're an entrepreneur, and basically entrepreneurs that grow businesses, you take them from small, start them up, you build them up with equity, and then you sell them. That's what a venture capitalist does. They grow up businesses and then they sell them off. And so that EBITDA is a big value in selling off business, because that tells you what it's worth, and your business is valued at a multiple of EBITDA. So if you come down to an EBITDA and they can say, okay, I will pay you 4 times your EBITDA for your business. That's why that's important for if you're looking at a person who's a venture capitalist trying to look into your business. And I've dealt with that before, and it's interesting, as there's certain multiples based upon types of industries of businesses. You got pre-tax income, all these, and then you have to also factor in taxes if it's for profit, to come down to after-tax income. So basically your net income after all those things, or your bottom line. And if you look at this example, it's showing a negative, for 1 month, and then it goes and shows positives in each month. And typically you want to break that down for your detail by month to month and summarize it for a year, so that you have an idea over that 3 to 5 year period of time, what is really happening. And then that becomes your budget plan, that when you monitor your actuals versus each month budget, you can sit there and analyze and make sure if you're on target or off target. The other part of that talk mentioned about was cash flow. So see how this is a budget Proforma up top, but the bottom part of it is cash flow. What cash do you have coming in to be able to control and see, and if you have it. And then it comes down to let you know, are you going to have, see, for the month of March, look at a negative cash flow of $400,000, even though you have just net loss of $32,000. That's why cash basis is a lot different than what your income statement basis is. And most investors will look at the cash flow more importantly, because they want to know if you're generating cash and how long it's going to take for you to generate cash and all that to operate, so that they know how much financing you have to make it. And you need to know it for yourself, that if you're going to go into business and you're going to pay out your own money, things like that, you need to know how much of cash is going to be required of me in order to be able to cover these things. So that's why, and Roberta, I was saying that even in a startup, you need a startup budget, so that you have an idea of what it's going to take for you to be able to have how much you have to put in to see if it's going to be worth it or not for you, for that investment.
I'm learning a lot of different things. Like they have this thing down here, I guess, where you can like do a contract to rent a room or something for your meetings and stuff like that. And so I wasn't sure, especially as a startup, I wasn't sure if that's the direction that I wanted to go, or something like that. But and I would probably try one of those 6 months contracts after I got my website established and got another job, which I'm in the process. Please pray for me because I just got fingerprinted by the federal government.
Yeah.
But I'm looking at that because I can see that for the first 6 months, really, once again, it's about marketing, branding, building a base,
Yes.
and establishing an executive board, which I'm just like, for the past 2 days, I just sent out a bulk of letters because the person working with me on my marketing, he's actually located in Toronto, Canada. He's moving back to the States. And he was like, I'll work with you, but I need you to, start getting your board together. And this is the type of board members that I need you to get, which is absolutely fabulous to get free help like that.
Yeah.
But like I said, it's just for that 6 months, I can see renting a room or something like that for 6 months, or even just going cheaper and establishing a relationship with the restaurant that has a private meeting room, even though we're in COVID.
Yeah.
But at least people will eat and be able to work at the same time. But looking at the different options in that regards, and then if I'm paying for meals, once again, that's another thing to take into consideration. But
that's all the things you need to look at, though.
Right.
And that's why I said, even in startup phase might be 2 to 3 years from some folks, because the reality is that I'm still in startup phase, because my goal is to get staff on, but I'm still 2 years into it. I'm getting more clients, I'm getting more different things, I'm learning more things, setting up different things, services and things like that. So that's why, regardless of what phase you're in, you have to take an anticipation of what your financial dollars coming in are going to be and what they're going to be going out, so you know what to expect. The reason when businesses fail, if they do a good financial plan and they're monitoring to it, there's no reason they don't know it's coming. The only it's just ignorance. It's people don't want to take the time to say it's going to cost me to do this. I mean, it's just like in the United States now. There are going to be a lot of people who are going to be destitute, because anyone that's growing up now that understands that if you're going to retire at your age of 70 now for full retirement, Social Security is not going to really be there. You're going to need at least $2 million saved up in your own retirement to live comfortably. That's just a reality. It's just math. When you do it, you take your lifetime, take about what take 80% of what you're used to making over your lifetime as that annual salary, and then estimate what it's going to take from a lump sum of money to of earnings at 7% or 8%. You're going to need $2 million. So, and most people want to stay hidden. And that's why I don't want you all, as you grow in your business, put it out there. If it shows all this red, you need to be able to know and be aware of it. And then there you can start working on a plan. Okay, how can I lower my expenses? How can I be able to generate other revenues? So start working on it versus just being in la la land and then it just blows up. So just to summarize on business budgets, you want to list out your sources of revenue, your contract revenue if you're a service business, sales, if you're products. You want to list them all out, itemize it, because the more detail you get into, you might have to get into, like if I was doing my business, how many tax returns that I expect to do each month, because typically during the tax season from February to April, that's where 90% of tax returns are done. So if you're trying to spread that out over 12 months, that's not realistic. So you need to factor that out. So then what do I do? Then I'm in downtime and on all those things. If you notice, people who are in the business, who are landscapers during the summer and spring and fall, they also then do snow removal during the winter time, because they're looking at the business and seeing the cycles of it. So that's why I said that you got to make sure you take your business and know when the ups and downs and seasonalities are, and plan that out. That's why you really want to break it down on a monthly basis. If you're a nonprofit, you want to know what your grants, your contributions, what you're going to need in donations to be able to run services or programs. And then there's other passive type of ways, rental income. If you have buildings, you want to rent out space, that's some rental income that might be coming in. Investment, you might have some investments that are helping out. So list out all your sources of revenue and try to get it down into a monthly basis. Same thing with your expenses. You got to take the time to really look at your expenses. You know, if you're going to be employee or, you know, have employees' salaries, payroll taxes, benefits, supplies, office expenses, rent, utilities, depreciation, really take the time and list those out. So as an exercise for, I'm going to give you a couple minutes. I want you, for your particular business, list out your different sources of revenue and then list out your different expenses that you think is related to your business. I just want to make sure you go through that process. So I'll give you a couple minutes and then I'll come back to you. I guess indication from majority are there. So Chanel, do you want to share with, what yours, especially with all that's going on, and, having an indoor place now and expanding from outside and the book that's going on. So, what's your sources of revenue?
So I just used my summer classes for an example. It was like a really low overhead
Okay.
and everything. So the classes were outside, so I didn't have to, pay for any space or anything. So I basically, my expenses were my marketing materials and the waters I used to buy for them on a weekly basis. And I'll say gas too, because I used to have to drive to go get those things. So marketing materials weekly was $10, water was $2, gas. So we'll say that was about $22. In regards to revenue, it would be 15. I would get up to 15 people, $4 per person. So it was $60 per class. If I was to do two, that could be $120. So that was my revenue on a weekly basis versus my expenses, which was about $22.
Yeah, you have a pretty good operating margin. Operating margin is the dollar amount of total revenues less expenses, and that's your operating margin. And typically, as a percentage, you typically want your operating margin being anywhere between 50 to 80% as far as operating margin. And then when it gets down to net operating, when you have other deductible expense like depreciation, things like that, you want it anywhere between 10 to 20% also. And those are part of the financial indicators that are on the financial plan that people look at too. And because the other thing too that you probably didn't factor in and that's going in is what we call cost of goods sold. Those are the expenses related to reducing your revenue. And like, for instance, your equipment, if you had mats or different things like that, that would be expense, but it'd be viewed as a cost of goods sold because to produce your services. Because that's,
Yeah, I did. So at the beginning, when I first started, I did order a bulk of things. The numbers I just gave you was kind of like what I did weekly, but at the beginning, I spent maybe close to like $600 just trying to get have everything, which is my mats, my tables, stuff to market everything. I got my flyers, my business cards, and everything like that. So I did at the beginning spend a bulk of money to get prepared for the 12 weeks, and then over the 12 weeks, that was like it was like little cost because I had set up everything at the beginning.
And so when I would go in and analyze, I would look at those total costs so that you can know what it is actually, because the way that you would look at it is the total amount that you spend up for all those other things based upon the number of classes, you would allocate some of that portion of cost to that so you can have an idea of what it truly, what it was really costing you per class to get to a per class. It's the same thing as like people who make and do restaurants and getting them to a per meal basis. That's where you get into the fixed cost versus the variable cost and then allocating it out. Because what you really want to get to then is make sure, if you want to look at a break-even analysis, this is all involved in break-even analysis, is the price that you're charging going to cover your fixed and variable costs? Because if not, you're going to be losing money. And that's where it gets buried into certain things. These quote, the hidden costs, those are the overhead costs. Those are the things that you do and you're required to do regards of, making sure you have your licensing or your renewal for memberships and things like that. Those are costs that are like fixed costs that you're going to have to pay regardless if you do one class or you do 2,000 classes. And so those get factored into the analysis when you're looking at your break-even analysis too. Okay. Yes, Roberta.
Just a question in regards to Chanel, and I'm just asking questions and hopefully, it helps at some point. Did you have them sign waivers? Waivers have to be submitted to attorneys and things like that, or whatever. I mean, because I'm not trying, please understand, I'm not a hater in the game. I'm here to support everybody. That's why I share as much as I can on the Loving Yourself page. If they sign waivers because you're outside, because you're the person responsible for the class, and if you know you don't have verification that they've contacted their physician, you know how they make you sign all that crap when you join like the real fitness centers. Did you factor in any of that in regards to your cost and how much it's costing you to do everything? Because unfortunately, we live in a litigious society where everyone wants to sue everybody, and then you tell somebody to do a jumping jack and they fall out, and then their family is coming after you for the jumping jack. So I mean, unfortunately, that's what it is. But do you have something like that in place, and an attorney that specializes? I guess, are there special attorneys just for that kind of stuff? Just things I'm just throwing out there, because I look at all of that too.
So to answer your question in regards to the waiver, I did have them sign waivers. However, I didn't have an attorney to submit that information to. So as I'm moving into my, I just recently got approved for a space. That is something that I am going to invest in, because of course, like you said, I do not want that type of liability on my hands when it comes down to people working out and everything. I am very stringent on, completing fitness assessments beforehand, determining what their level of fitness is. But I do, and I appreciate you bringing that to the forefront in regards to making sure that I have an attorney, because that's like my next step in both of my businesses, is getting an attorney, just to have those things in place, just to cover me. So thank you.
And one of the things I can make a suggestion too is that, I have liability coverage, just even I'm in a financial, but I have liability in case I do an assessment or people try to rely on, they don't want to sue me. And if you're looking at getting liability coverage, your insurer might have in a sample waiver information they want to incorporate into your program too. Since they're going to be covering anything if someone falls out or whatever too.
Right. Okay. Thank you both. I appreciate it.
You're welcome.
Anyone else have any, they want to, have anything about the financial plan?
One of the things that I remember from all the videos that I had to watch for the cohort that I was in when doing a financial plan or a budget is unemployment. The unemployment piece, once you have staff that you have to pay like a certain amount, because I had to watch all those tax stuffs and all those deductions and everything. And sometimes we forget about that when we're looking at our budget. Yes. Because that's another deduction that you have to take into consideration, especially when you're hiring people, that and the workman's compensation stuff, even though the employee pays into that, the employer still has to pay a certain fraction of that too. So just to keep all of that in mind when doing your budget, because it's the little things like that we forget. And then when tax time comes and somebody asks us about it and we're like, what, why?
Well, that's a good point, because when you look at salaries, if you have employees, then on salaries, you got payroll taxes, and then you got benefit, and then you have benefits if you have a health plan and things like that. And so typically when I budget about 25% for both payroll taxes and benefits of salaries as an ongoing S&I. And that's usually what's in the ballpark across the board. Okay. Time's approaching us. The last thing I want to talk about before we, close up is budget. What are some budget resources for folks? Excel is something that I use still. It's more for financial analysts, accountants. Most business type people will use Excel. It's a spreadsheet package. You can do budgets. There's templates. That's something you can do. And then So I usually start my budgets in Excel, and then I upload them to any other package I'm working with. QuickBooks, you can budget through QuickBooks. And so as a small business owner, QuickBooks is really, Intuit is really pushing QuickBooks out there to a lot of people. I use QuickBooks for my own personal business. There are certain businesses it's good for, but if you get too big, then it's not going to be good. Because right now I have some clients that I'm moving from QuickBooks into other packages. Because QuickBooks is for a small business owner, not many, different products and things. And it's great because you can link your bank accounts up. You can have payroll. If you use paychecks, you can link up their payroll file into there and all that. But at the same time, you have an ongoing annual subscription fee that you have to pay. It's between $200 to $300. It's cloud-based. I like that. So you can get it on your phone, your computer, things like that. But at the same time, you might need someone else to help set it up as far as the chart of accounts, because they have sample chart of accounts. But at the same time, if you're going to get into complex transactions, you might need some additional support. And that's why, either a financial analyst or an accountant can also help with preparing budgets. So think of that when you're planning your budgets and for your budget plan, for your business plan. You might want to include some of that time for contract basis in there to get some of these high level analysis and ratios and things that you might want to prepare for. Once again, I keep referencing back, How to Start a Business this is a good book that I've gone through, and I keep mentioning that if you want to look at some materials. And opening up for questions, just as a reminder, you can, have Visions is out there on Twitter, Instagram, Visions 2020 LLC, Facebook, and then YouTube. I have a Vision page. I upload the videos and sessions out there, the materials. If you're part of the private Loving Myself group, you have those information that's out there also too for you. And then you can always ask through email or also through the private group, the Visions page. We can, put in chats or questions and we can respond. Once again, I'm asking for those that might have topics they want, because I prepare these topics, each time. I want to start working on next year. So if there's some topics that you were interested in, I'll gather those up and start and work on those and set up the syllabus for next year. Next month's session is Understanding Financials. That's November 13th, Saturday, November 13th from 10 to 11 Eastern. So any questions that anyone has is open, for questions that you might have that. Wow. So I know it was a lot of information, but once again, I'll be uploading the video and the information, the presentations. But at the same time, we're going to follow up next month. That's why I made this a two session of dealing with financials. So if there's other questions related to, we'll follow up on that again next month. But I thank you all for attending and looking forward to you November 13th. If you have questions in between, go ahead and hit me up on Facebook and into the private group also. Yes, Roberta.
Just wanted to say thank you and continued success to everybody.
Yes, let's continue to grow. Everyone's doing so great and expanding. I'd like to see you going bigger and bigger.
Thank you.
Thank you.
You guys are all welcome. See you next month.